All right, let's dive into Dell's latest earnings. There's a really interesting puzzle at the heart of this report, and we're gonna unpack it.
So check this out. On one hand, Dell's quarter looks absolutely fantastic. I mean, record revenue. They're killing it with their AI stuff, and they even told Wall Street to expect more for the rest of the year. But then, the stock tanks after hours. What gives? What did the market see that just spoiled the party? That's the big question we're digging into.
Okay, first up, let's just look at the big flashy numbers because they were seriously impressive. Revenue, a record-setting $29.8 billion. That's a solid beat, and it's up 19% from last year. Then you look at their earnings per share, $2.32. Again, better than what Wall Street was expecting. So by any normal yardstick, this was a great quarter.
And then this happens. The market's reaction? A 5.3% drop in after-hours trading. It just doesn't add up, right? This is that paradox I was talking about. How does a company beat on both revenue and earnings and still get slapped down by investors? Well, to figure that out, we've got to peel back the layers and look a little deeper. Okay, so the first and honestly the most jaw-dropping part of this whole story is what's happening with Dell's AI business. It is just exploding. Dell themselves are calling the demand exceptional, and they are not kidding.
Let's put some numbers to this, because the scale is just staggering. In Q2 alone, just one quarter, they booked $5.6 billion in new orders for their AI servers.
And it's not just orders piling up, they're getting these things out the door. They shipped a record $8.2 billion worth of AI servers. That tells you their supply chain is running on all cylinders.
And get this, even after shipping all of that, their backlog, the stuff they still have to build and ship, is now at a massive $11.7 billion. That is a huge pipeline of revenue just waiting to be recognized.
If you need any more proof of how fast this thing is moving, listen to this quote from Jeff Clark over at Dell. He said, "We have shipped more AI servers in the first half of this year than all of last." Just let that sink in. The first 6 months of this year beat all 12 months of last year. That's insane momentum.
And look, they're so confident this is going to keep going that they've jacked up their forecast for the whole year. They were originally thinking $15 billion in AI server shipments. Now, they're guiding for around $20 billion. That's a huge vote of confidence in their own business.
So you're probably thinking, okay, incredible AI growth. So where's the bad news? Well, to find that, we have to split the company in two and see how each half is doing.
And boom, here it is. It's truly a tale of two Dells. You've got the Infrastructure Solutions Group, or ISG, that's where the AI servers live, and it's on fire, up a staggering 44%. And then you have the Client Solutions Group, CSG, which is their PC business, and it's basically flat, up just 1%. Total night and day.
Now, even inside that high-flying ISG group, it's not all sunshine and rainbows. The servers and networking part, again, that's the AI engine, was up an insane 69%. Record-breaking stuff. But look at their storage business. It was actually down 3%. That's a bit of a soft spot, a little crack in the armor.
And over on the PC side of the house, yeah, things are pretty sleepy. Commercial sales edged up just 2%, and the consumer side actually dropped 7%. Now, there is a big but here. The big hope is that the end of Windows 10 support is just around the corner. We're talking less than 2 months away. Dell is betting that this will force a ton of businesses and people to upgrade their PCs, which could be a huge shot in the arm for this segment.
Okay, so let's recap. We've got a rocket ship AI business, a snoozing PC business, and a little weakness in storage. But even all that, it doesn't quite explain that big stock drop. Now we get to the real reason the market got nervous, and it all comes down to one word: profitability.
It really boils down to two numbers that just spooked investors. Number one, their adjusted gross margin. It came in at 18.7%, and that was lower than expected. Number two, their profit forecast for next quarter. They guided to around $245 a share, but Wall Street was looking for something closer to $255. So, a miss on current margins and a miss on future profit guidance. That's the combo that did the damage.
And this is where you get this clash of two stories, right? You have Dell's management on one side, painting this incredible picture of AI-driven growth for years to come. And then you have the market, which is always focused on, what have you done for me lately, honing in on the margins, and the next quarter's profit. The big hanging question became, yeah, the AI revenue is amazing, but can you actually make good money from it?
So, where do we go from here? We've looked at the good, the bad, and the ugly. Now it's time for our take, what we're calling
the next call.
Now, to be fair, management isn't just sitting there. They have a game plan for fixing these margins. They're talking about value engineering, which is code for making things cheaper to build. They expect to get more efficient as they build more and more of these servers. Plus, they want to sell bigger, more profitable packages to their big enterprise clients. And importantly, they said some of the costs that hit them in Q2 were a one-time thing and shouldn't happen again.
So what's our prediction? Honestly, expect the stock to be a bit volatile for a while. Everyone is going to be watching their next earnings report like a hawk to see if this margin plan is actually working. So yeah, the mood is cautious right now. But if they can prove the profits are coming and that PC upgrade cycle really does kick in, then there's absolutely a path for the stock to move higher. Which brings us to our final rating. We're slapping a market perform on this one. Here's why. That mind-blowing AI growth puts a solid floor under the stock. It's not going to fall off a cliff. But those profitability questions, they put a ceiling on it for now. Dell basically has to prove it. They need to show us they can turn this gusher of revenue into a gusher of profit. Until then, we're not ready to be more aggressive.
So how might you play this if you're an investor? Well, one idea that tries to balance that long-term hope with the short-term fear is something called a synthetic covered call. And of course, a huge disclaimer here, this is not financial advice.
Let me break down how it works in simple terms. First, you buy the stock, right? You want to be a part of that big AI growth story. Then, you sell a call option at a price higher than what you paid. This brings in some cash right away and acts as a bit of a cushion. And finally, you buy a put option way below the current price, which is basically insurance against a big drop. The whole point is to capture that long-term AI potential while protecting yourself from the bumps in the road we might see in the next few months.
And that's our look at Dell's Q2. It really is a classic Wall Street story, isn't it? A company with a phenomenal growth engine running up against the market's demand for profits, right here, right now. It's going to be a fascinating one to watch. And as always, remember, this is not financial advice. Please do your own research.